Hey guys, what's happening? It's good to be back for another week of the Wealth Circuit Investing Hour. We're going to talk tonight about this famous check mark pattern in December. Talk about whether it's something that we can depend on, whether it's something we should trade around, and just come up with some thoughts around that. Again, this is not investing advice. I can tell you what I'm going to be doing about it, but you got to make your own decisions about this kind of stuff. So it's good to see you guys. So we're going to talk about that. We're also going to, looks like there was a letter that was published on Parker Hannifin by Simply Safe Dividends. We'll probably go over that as well. And then pretty much whatever you guys want to talk about, that's what we're going to talk about. So with that, let's see who is on tonight. Looks like there's not a lot. So we're going to kind of hit these real quick. We got Michael Swami. He is shivering down in Texas. So it feels like it's 38 degrees, but now Michael sells natural gas to customers. So I would say, Michael, that feels like money to me. So that's kind of good. It's good to have you on, my friend. And also we got Pat. Pat is probably shivering as well. I don't know, Pat, if you made it back down south yet, but I bet it's a little chilly up in the upper peninsula of Michigan. And yeah, sorry about your Wolverines, man. It's Ohio State's pretty tough this year, dude. But yeah, it feels like cash flow. That's right, buddy. You know, it's awfully good when you can put a jacket on and say, man, this feels great. This feels like money. It feels like cash flow. So that's fantastic. So let's get started with the curriculum tonight. I'm going to go ahead and hit this over right here. I've been having some respiratory stuff, so hopefully I'll be able to get through without grossing you guys out too much. And tonight we're sipping on the famous half and half iced tea. That's half sweet, half unsweet. And I love that. Oh, by the way, let me just mention this about the bees. The bees, it's a little chilly for the bees right now. So we are leaving them. I've kind of cut the drafts down that would impact them. Made sure they had enough food. And this year I've done something a little different. I'm putting insulation on the top of the hive so that condensation doesn't build up there and rain down on them. And I'm hoping that'll be a big help to them. So I am also in the process of putting my strategy together for 2026. I'm planning to expand the hives. I call it my apiary. I plan to expand the apiary, looking to go from 6 hives, which I have now, to 20 in 2026. I'm also planning to grow my own queen bees, which will be a new thing for me. And I know that some people do it, but it's not a normal thing. And I'm hoping that my eyes aren't too old to do that, because you're looking for an egg in the brood chamber that the queen has laid that is no more than 3 days old. Well, no less than 3 days old, no more than 4 days old. So you're looking for just a very tiny little egg. And, it's kind of hard to see that. So I'm going to do my best. And the idea is you get that egg out, and then you can, trick the bees into thinking it's a queen cell, let them build that out, and then you incubate it just like you would a chicken egg and let the queen emerge and put her in the cell. Hopefully they will accept her. And so it's going to be quite a different thing for me. So I'm looking to expand the apiary. I'm looking to grow my own queens, and life is good. So I'm also planning to put some curriculum together for beginning beekeepers. So there's a lot of them in the area, and I want them to, gain some knowledge before they take a package of bees and dump it, in their backyard. So looking to do all of that on the bee side. So a lot of things going on for a retired guy, but man, I love it. I love new things. I love learning, as you can tell. I love learning. I love sharing what I've learned. And so I not only want to do that on the bee side, but also want to do it on the stock side. So let's go ahead and get into what we're going to talk about this week. But first, as always, we will update on year-to-date performance of the portfolio. You can see that the gray line, which is the very top line, is NASDAQ. NASDAQ shot up for the week. This is as of Friday, because the brokerage doesn't update in time for this broadcast for today's information. So we get Friday's information, but we are tracking it pretty close. We're right behind it. We are beating the S&P. We're beating Dow Jones. We're beating the Russell 2000, but we are behind the NASDAQ on a year-to-date basis. Here's the numbers. We're going to look at total return. Since I didn't do a broadcast last week, I went ahead and put where we were 2 weeks ago, last week, and this week. You can see that we started at 17.38% on 11/14, dropped to 16.12%, and then shot back up to 19.11%. So it's a pretty good week last week. But man, I tell you, my goal is 8% per year consistently. And to be at 19, I just think I just feel pretty good about that. Not to mention beating the S&P 500. So we're liking that. I'll talk about this risk-adjusted return a little bit later when we talk about a new software that I'm looking at. So, but with that, one other thing we do is compare this AI portfolio. For those of you that recall, on August the 11th, we asked Gemini and ChatGPT to put together a winning dividend growth portfolio. It did that. We built a spreadsheet that is tracking the performance of both of those against also the S&P, the NASDAQ, Dow Jones, and my personal portfolio. And believe it or not, right now, the Wealth Circuit Investing portfolio is still in the lead at 9.09% since August the 11th. So from August the 11th to December the 1st, which is today, we are up 9.09%, $151,000, 3 months. That's hard to believe. And then NASDAQ is up 8.84. Dow Jones is up 7.54. The S&P is up 6.89. Now, the ChatGPT portfolio is up only 2.26, but that is much better than the Gemini portfolio that went down 2.78. So there's that. So let's talk about this December check mark, or J-hook, as they call it. Now, when I started looking at this, I got information that said this is a famous pattern. This is, and it may be, but I didn't know about it. So I figured if I didn't know about it, then maybe there's one or two folks on here that didn't know about it either. Or you may have heard about it, but maybe we should look into it a little bit deeper. So this is the December check mark, or the J-hook pattern. This is a visual illustration of what that looks like. So as you can tell, the first half of the month of December kind of is flat to down, while the second half of the month is up. Now, this shows it going straight up, which typically doesn't happen, but you get the idea, right? It's like, hey, the first half of the month, we're going to be kind of going, well, is there a bear market? You're going to hear all this stuff, especially on the Discord. Oh, the bear market is hitting. But in reality, there's a lot going on in the month of December that drives this certain pattern. So let's talk about that. Well, first of all, before we talk about that, let's look at, this is actually a chart that I found that shows 20 years from December, 20 years of December information from 2001 to 2021. So you can see it is pretty clear that there's a bit of a check mark here. See that it raises a little bit and then drops and then comes back. So there's this idea that over this long period of time, there's this check mark pattern that keeps continuing to show its ugly head. So what are the date ranges here? December 1 to December 6th, it's flat or a slight drift. So post-Thanksgiving hangover is what they say. Markets are often open markets often open the month with low volume and a lack of direction. So there's a bit of uncertainty typically in the first week of December. I think we're seeing that today. The markets are down a bit. But so I think we're probably going to see that the rest of this week. Then there's the dip, December 7th to the 15th. This is historically the weakest part of the month. Tax loss harvesting accelerates as retail investors sell losing positions. I'll talk about each one of these in a few minutes. But then the funds often rebalance. So this is what's considered the buy zone. The second week of December is typically what's considered the buy zone. I want to, put some caveats around that here in a few minutes. But then there's the climb, which happens from December 16th to the 24th. And then basically we have the spike, which is the Santa Claus rally, which is December 26th, actually through the 2nd or 3rd of January. So let's talk about some of these and what they really mean. So December, the first half of the year is tax loss selling or tax loss harvesting. And what tax loss harvesting is it's investors sell their stocks that are down on the year so that they can offset those any capital gains that they've recognized in the portfolio throughout the year. So if they sold a stock that made $100,000 and then they can sell a stock that has lost $100,000, they'll end up now, there's a long-term, short-term component to that, but if they can match all that up, it means that they won't pay any tax on that. And the idea is that they can wait a certain number of days. I don't remember exactly how many it is. I want to say it's 31, but you'll have to check that, check me on that. But then you can re-enter the stock after that amount of time. Otherwise, it would be considered a wash sale, and you would not be allowed to deduct the loss. You would have to you'd have to pay tax on the gains, but not deduct the loss. Then there's the what they call the second, let's say the second third of the month. It's considered window dressing. Now, what is window dressing? Window dressing is when mutual fund managers want their year-end reports to show that they are owning the winners, that they have a winning portfolio. So they will often pile into stocks that are winners. So if somebody's looking at a mutual fund or an ETF, they want to see winning stocks in there. And so if they can get those in the year-end report, then it makes them look like they are really on top of things and are buying into the stocks that are winning. Even if their performance is not there, they will actually see that the stocks that they have are winning stocks. Then there's the Santa Claus rally. This is a statistically significant surge in stock prices that typically occurs during the last 5 trading days of December and the first 2 trading days of January. So you have these basically 3 things going on. That's why you have this selling in the first half of the month and then this rise in the last half of the month. Now I want to show you that this does not always work. So if you're thinking about, man, I'm gonna play this, everybody evidently, I didn't know much about it, but everybody knows about this, so everybody's going to be trading against it, right? So the worst thing you can do is to trade an obvious pattern because everybody else is going to be doing the same thing, and it's just basically going to disappear. So, but anyway, here we go. I wanted to show December of 2024 for the Wealth Circuit investing portfolio. That's my personal portfolio. And I wanted to show this because the weekly, I look at my return weekly. And so you see here on December 6th of 2024, the portfolio went down 1.15%. Then on the 13th of 24, December 13th of 2024, it went down another 0.38%. Then on the 20th, it went down another 3.07%. Then on the 27th, but right back up and went up 0.73. But then at the end of December, it went down 0.98. Now, you see here, and I did a little chart of this, and you see that there is a bit of a check mark here, right? There's a bit of that check mark pattern going on. And so it drops here at the end of the year, so it doesn't go straight up for the rest of the time, but there is a bit of that check mark. But here's what I wanted to show you, and this is why we got to be careful with this trend. Here's the actual return. So when I started the month of December on 11/29, the year-to-date total return of the portfolio was 20.37%. Then it drops by 1.15, then it drops by 0.38, then it drops by 3.07. It comes back up by 0.73, but then drops 0.98. So by the end of the month, I go from 20.37% year-to-date through the end of November to only 15.2% year-to-date December 31st. So if I had, thought, I'm going to buy this dip, now, it would have turned out well in the long run, right? Because here we are in 2025. We're about 20, I forget what I showed, 19% gain on a year-to-date basis. So if I had bought, this dip, it would have been fine in the long run. So, but you never know, right? So I just wanted to show that it doesn't always work. So if you're looking to say, hey, I'm going to really go after this pattern, I'm going to do some maybe some covered or cash secured puts. I'm going to do some short selling. I'm going to, whatever you want to do to try to take advantage of it. It doesn't always work. So, as my dad used to say, you pays your money and you takes your chances. So, if you want to take your chance, it's up to you, man. So, I think that's it for this segment. So let's go back and see what you guys have on your brains tonight. So that's what I wanted to share. Let's see here. All right. Pat says he's been south for 4 weeks. He missed out on the 28 inches of snow. My goodness. And he's there until April. He's there until the big thaw. So that's good, man. I'm glad to hear that. Michael sold Starbucks and bought HESM last week. Coffee is more of a commodity than gas. I think that's probably a good move. I don't know. I guess any kind of, real significant growth for Starbucks would probably come from China. And I'm not sure they've got the wherewithal to make that happen anytime soon. So I think that's probably a good move. Now, I went to Starbucks the other day, and they have changed their whole menu. So they're doing a lot of things to try to right the ship. I'm not sure that they're going to get some benefit from that as a company, but I don't know that it's going to give the growth that was priced into the stock at one time. So, we'll just have to see, but I do think HESM is a good play. Worst case scenario, you're getting about a 9% dividend yield. So, it can't be all bad, right? So that's actually a pretty good move, I think. Hey, honeybees in the room. Good to see you. I was talking about my honeybees just a few minutes ago. John Jay is in the house. Let's talk about investing in December. So we did that. Let's see. I left. I'm not sure what that is. What is Samarkand? Maybe it's something that we don't get here in Alabama. I don't know. Yeah, best ideas for investments in December. Yeah, we could chat about that. How many pounds of honey do you get every year approximately? I would say it depends on the number of hives that you have. So if you want to think about it this way, every hive, if you have 3 honey supers on it, you could get anywhere from 90 to 105 pounds of honey per hive. So, we typically think of it like that. So, right now I got 6 hives, so I have the potential. Now I only was able to get honey from 3 this year, but next year they will all be producing. But yeah, that's the way to think about it. So if I get to 20 hives, I could have approximately 2,000 pounds of honey. That's a lot of honey, man. Yikes. Hey, Gendry's in the house. Good to see you, buddy. Yeah, you like my hat, man. That's good. AVB is a buy now. Let's take a look at it. Let's take a look at AVB. I'm going to get rid of this. Avalon Bay Communities. That's a REIT. Let me show you guys what I'm looking at here. AVB, Avalon Bay Communities. It's a very safe dividend. Credit rating is A-. Can't go wrong there. Dividend yields 3.9. That means that their investors like them pretty well. Let's take a look and see what they do. Residential real estate. Develops, acquires, and manages apartments across major metropolitan areas. It focuses on New England, New York, New Jersey. Those are some high rent districts there. Mid-Atlantic, the Pacific Northwest, and looking into Raleigh-Durham. I've got a family member there. Southeast Florida, Dallas, and Denver. All these, high rent districts is where they're focusing. Firm manages over 300 communities, 90,000 apartment homes. That is incredible. Let's see. Payout ratio is 69%. I'm not sure that matters a whole lot. They are growing their dividend by 2.3% over the last 5 years, 2.9% recently. Let's see. Valuation. Yeah, I think, things are looking good. Sales growth is consistent. Shares outstanding, you do expect that they would issue shares. They're not going to be buying them back because of the way they're structured from a tax perspective. Total sales are growing. Return on invested capital is not bad at 4%. Not bad for a REIT anyway, at 4%. Net debt to capital, that looks pretty reasonable. Interest coverage is good. So, yeah, let's do this real quick and see what Morningstar would say their valuation is. Avalon Bay, it's down $2.29 today. Let's see. Oh, it doesn't think it doesn't think I have a subscription. Hold on. There we go. That's much better. You can see it now. Yeah, it's at a 23% discount. So, yeah, I don't see anything wrong with that, Gendry. I think it's a pretty decent opportunity. I don't know what specifically, other than 90,000 apartment rentals that they have, but man, that is. They're undervalued. They're doing well. They've got a great dividend safety rating. So I think they're in good shape. Let's see. Sell 6 assets for funding acquisitions, development, and share repurchase. Oh, wow. They're going to do some share repurchases, which is kind of odd for a REIT. But, maybe that's how they're believing they can get the most value. Because what that would tell me, if they're doing it, so you can see this headline right here. What that would tell me is they believe as a management team that they can raise cash by selling some of their underperforming assets reinvest those funds into the stock of the company and retire those shares and get a better return by doing that than they would by buying some other real estate. So it tells me they're on the ball. So I think that's pretty good. That looks good to me, man. All right, Pat, ADP, BUI, UTG. So automated data processing. Now let me do a quick look here because I'm not sure I know what BUI is. Oh, BlackRock Utilities. It's a trust. It's a closed-end fund. Okay, that's why I didn't know what it was. And then UTG is also, that's the Reeves Utility Income Fund, which is also a closed-end fund. But I have heard of that one. And those are good for those of us who like a little bit of income in our portfolios. So I think we're in a similar situation there. But yeah, the Reeves, the UTG, has got a 6.35% dividend yield. Yeah, let me just show you. There we go. UTG, 6.35% dividend yield and a 80 safe dividend. It's trading at about a 0.3% premium to the net asset value, but that's okay. That's nothing wrong with that. And let's take a look at that other one. What was that? BUI. BlackRock Utilities. It's a 70 safe dividend yield of 6.15. It's trading at about a 1%, but it has come down here recently. And but yeah, I think both of those are reasonable for portfolios like yours and mine, Pat. I think that's good. Michael says that CVX is much better benefactor than Hess for Hessam. Okay, well that's good. I'm glad to hear that. Maybe I may add some more then at some point because it is much lower than it was this time last year. It's actually one of the stocks that I have lost the most money on. Speaking of that, let's do this. I've been looking at this program called Snowball Analytics. And I look at it because, I mean, my spreadsheet does well, but it is sometimes hard for me when I'm off traveling to sign in through, all of the firewalls and stuff to get to my spreadsheet so that I can see what my portfolio is doing. So, it is nice sometimes to have something that is web-based. So anyway, I heard my buddy Ryan talking about Snowball Analytics, so I started playing around with it. And I went ahead and got their Black Friday thing, which I think goes until December the 3rd. I will say I get nothing for this. I've not signed up for any partnering agreement, any kind of whatever they call that, associate or, anything like that. This is I get nothing for this. So if you sign up for Snowball Analytics, it's all on you. I get nothing. This is just me trying to find something that works well when I'm out away from my computer. There's some good information here. I will say that, from my perspective, from my portfolio, I had to do some things when I retired, like roll over my 401k into a rollover IRA. This only will go back to that point. It won't let me go back to actually when I retired because the accounts are new and it can't read it. It just doesn't have that information. My spreadsheet has all of that because I was able to pull that in from the old accounts. So anyway, but there is one thing that I found to be really cool. So you can see it's got, what is this? This is just like returns, diversification. You can see how diversified I am. This is my VU. This is the S&P 500 ETF that I have, and that's a pretty big chunk. Next largest is Microsoft, and then you come to Google, and then Amphenol, and then the money market. I've got $60,000 in the money market account. So anyway, that's cool. But I will show you what I think are a couple of things that I really like about Snowball Analytics that maybe I can build into my spreadsheet at some point over the next year, while this thing, because I paid for a year of this thing. So this is pretty cool. Shows the portfolio value over time. This is a year to date. I could look at it in 7 days, 1 month, 3 months, 6 months. It's just pretty interactive. Year to date, it shows that I'm above the S&P 500. Here it is in a percent. If I hit compare, there we go. The blue is my portfolio. The yellow is the S&P. You can see that we're 19.15. They are 18%. So, we're outperforming the S&P on a year-to-date basis. So you can see all kinds of, there's a heat map here of how the stocks are doing. But then this is what I found to be, here it is. This is what I found to be kind of cool. They've got this time-weighted return, which I don't know if that works well or not. It is in beta, so I don't know about that. But if I look at the volatility, and I'm not a follower of the volatility theory, but it does show that my portfolio has less volatility than the market. They use a risk-adjusted, now this is also the cool thing. They use a risk-adjusted return, but they use a Sortino's ratio rather than a Sharpe ratio. And I kind of like the Sortino ratio better. I can probably do a show just on the difference between the two. But you can see here that it says it requires attention. My portfolio is 1.845. But the S&P is 1.514. So, according to them, anything below 1 is bad. Anything above 2 is good. So I'm at 1.8 something, 1.845. I'm okay with that. I've got a bit of risk out there, but it's not terrible. So yeah, I'm good with that. I do like this Sortino's ratio. So we'll see how that plays out. But if you're looking for something that tracks your portfolio, gives you some information that you typically wouldn't get from your brokerage account, something you can take a look at. They do have a Black Friday sale, but again, I get nothing for that. So I'm not sharing this to say as a commercial. I'm just saying this is something that looked pretty cool, and so I'm going to use it for a while. Maybe take some of this stuff, try to build it into my spreadsheet. So anyway, we'll have to see. I don't know why. Oh, yeah. So the reason I even went in here was looking at this growth. This is, where's it at? You can tell I haven't played with this too much. There's a particular chart that I'm looking for, and I just don't see it. I wanted to say it was here, but I don't see it. Maybe it's in view details. Nope. Well, that stinks. Because it was going to be really cool. Oh, well. Guess I can't show it to you guys because I can't find it. Then I'm going to be like really ornery about it and look for it. But it is just not here. Well, maybe I can just describe it. It's got to be here somewhere, dude. It is dividend counter, Michael, cash categories. Well, I can't find it, but it basically shows your performance for every holding that you have and then you can pick these dates, right? You can pick 1 week, and that's going to really stink if I can't find this. That is really awful. Definitely not in here. These are all dividends. Dashboard. Analytics. It's basically a chart that starts on the left and goes to the right. It's not there. Oops. Didn't mean to do that. It's not in there. I wanted to say it was in this growth thing, but I do not see it in there at all. There it is. There it is. It was on the wrong chart. All right, here we go. So if I wanted to say, hey, what is the worst performing stock that I've had for the year? I would have thought it was Hess Midstream, but year to date, it's only down 1.8%. Let me see what on a 1 year basis, it's down 3.7%. The only downside is there's nothing between a 1 year and a 5 year. So if I hit 5 year, Hess is actually going to show me making some money on it. So up 28%. But yeah, at 1 year, it is down 3.7. My worst performer over a year is United Healthcare. That's a big shock. But, so the cool thing is I can go, hey, what did I do year to date? Look at Amphenol here, year to date up 104%. That is so nuts. Google over the last 6 months is my big winner at 66%. Over the last 3 months, Google is also the big winner. Amphenol is a big winner. Sox is a big winner. Parker Hannifin's a big winner. Even United Healthcare is a big winner over the last 3 months. So you can kind of get a sense for where the stocks have gone. So I was thinking, Michael, that I ended up with Hess being my biggest loser for the year, but it's not. Oh, well. Guess that's what I get for thinking, right? Yeah, I don't know what ABB's vacancy rate is, but I will say that they don't have a huge dividend yield. So I think investors are feeling pretty good about it. What's up, my friend? Dapper Dividends, Mr. Russ. Good to see you, man. So what's the 90-second take on Kinsale Capital? Well, I don't know. I don't think I've ever heard of it. KNSL. You're always coming up with some really cool stuff, man. Kinsale Capital Group. Oh, here's why. Here we go. Let me do this. Dividend yield is 0.18. It's got a dividend growth 13.3. There, it's unrated, which means it's not covered by Simply Safe Dividends. It's a property and capital casualty, not capital. Property and casualty insurance. It's in the U.S. Started paying a dividend around 2015. Earnings payout ratio looks pretty good. It keeps dropping, which means they are growing their earnings per share like crazy. That looks good. Sales growth looks good. Shares outstanding look fine. Return on invested capital is nice in the mid-20s. Can't beat that. Interest coverage is good. Yeah, I don't know, Russ. That looks pretty good to me. Let me see if Morningstar covers this. KNSL. That's down $7, down 2% today. They do cover it. So they're trading at a 5% discount. Oh, that's on the Q rating, so it's a quant rating. I don't really trust those, so I don't know from a valuation perspective how to think about it. But I mean, the financials look fine to me, Russ. It's not covered by either Morningstar or Simply Safe Dividends. It's a $9 billion market cap, so it's a mid-cap stock. It trades pretty much at market. It's a 0.96 beta. So, but it doesn't have much of a dividend, so you got to be in it for the growth. And so I would want to know, where's their growth coming from? And let's take a look at. Let's take a look at the chart. That is the 1-day chart, but let's look out, 1 year. And it seems to be dropping like a rock. Let's look at the 5-year. So it in 2021, it was down around like the 150 range, 175, and then it shot way up to 525, and that was in the March 24 range, dropped way down and came back, and that has been a sawtooth pattern until recently, and it is dropping. So there's got to be some story behind that, Russ. I don't know what it is. It's not readily apparent to me. Let me see if they've got anything cool to say about it. Oh, they don't cover it. Never mind. So, yeah, I don't know. There's something going on that's causing the stock to drop here recently. So I would want to understand what that is. Maybe look at their 10Ks, 10Qs, get a sense. Any kind of analyst feedback would be helpful. So, but yeah, from a financial perspective, I don't see anything wrong with it. I think it's definitely worth looking into if that helps. MUSA, Musalix, MUSA, Murphy Oil. Murphy USA, not Murphy Oil. It's also got a quant rating here. Let's see if MUSA. Yeah, it's not covered by either of those as well. It's a mid-cap, $7.2 billion stock. Double B plus credit rating. Let's see, triple B minus is the lowest investment grade credit rating. They are at a double B plus, which is, I think, one grade below. Yeah, that'd be one grade below investment grade. Let's just make sure. Yeah, here we go. Triple B plus to triple B minus is investment grade, moderately strong, and then it goes to junk grade, which is double B plus to double B minus. So, yeah, I'd be a little bit concerned about that. They are growing their dividend like crazy. Their dividend yield, though, is very small. I mean, you can grow 1 penny dividend by 20% a year, and it's still not a ton of growth. Let's see if there's anything in the financials that look. They're buying back a lot of shares, though. I mean, you got to give them that. Return on invested capital looks fine. Ooh, net debt to capital. They are heavy debt. They have a heavy debt load, but they have a decent interest coverage ratio at nearly 7. So that's reasonable. But man, they've 83% of their capital structure is debt. So I would want to understand their cap structure a little bit more. I don't know a lot about Murphy USA. I think the Murphy Oil was bought by ConocoPhillips, and that's turned out to be a very good thing for ConocoPhillips. But I don't know much about Murphy USA. Let's see. Hey, Fast Eddie's in the house. Good to see you, buddy. Let's see. Oh yeah, I forget there's a football game on. So the Patriots are kicking the Giants. I can't tell what that is, but I can guess. Uh, Maybe it's a goose. Yeah, it's a goose. All right. Yeah, this is definitely live, my friend. And I'm glad I finally found that chart because it was bugging the crap out of me. Wow, that's great. Broadcom is an 11 bagger. Whew, that is great. So Houston's at 45 degrees. That's awesome. Let me see what it is here. It's 42 here. It's a little bit chilly. So Dapper Russ says KNSL is for total return. Obviously, income investors aren't going to like it. Yeah, and I would say it's not even really total return. It would be capital because there's just not much from a dividend perspective there. So you're looking for growth there. It is definitely a growth stock. It's not really a balanced stock. I see somebody like J&J as like a balance between growth and dividend. But KNSL would definitely be a growth-oriented investment that just happens to pay a small dividend. So nothing wrong with that. I've got some of those in my portfolio. All right. It's been on his radar for a while, and he started a position. Take a ride. All right. Good job. Let us know how it goes for you, man. So MU. What is MU? MU. Micron. Let's take a look at Micron. It's got a 60. It's dividend safety. Dividend yields is small again. Payout ratio is so low. Look at that. That's great. They haven't grown the dividend in a while, though. I mean, if you're going to have it, grow it. You know what I mean? It's like if you're not going to have a dividend, don't have a dividend. But if you're going to have a dividend, grow it. If the business is growing, grow your dividend. Like they listen to me, like they really care, right? The earnings payout ratio continues to drop, and that's okay if they're taking that money and they're investing it. But if you're not going to have it, get rid of it, and get rid of all the costs that go along with it because you got to distribute that money every quarter. If you're not going to grow it, don't have it. And I mean, if it's just going to be a afterthought, then don't even have it. Just be a growth stock and move on. Nothing wrong with that. There's a lot of companies that we like that are growth stocks. It's like they're just toying with us, you know? Yeah, but Micron looks pretty good. I think their capital allocation process looks like it's a little disjointed with that dividend. So, and they don't have to grow it much, but grow something anyway. If your business is growing and you give a dividend, grow your dividend a little bit. Doesn't have to be much. Just grow it some. Anyway. CNI is Gendry's number 2 position. C and I. Canadian National Railway. Yeah, I tend to stay away from anything outside the U.S., and I've shared my thoughts on that many times, so you guys don't really care. Dividend safety is a 97. That's incredible. 2.66 yield. Dividend growth around 5%. So that's good. Payout ratio looks fine. Wow, last 5 years, 9.5%. It is slowing a bit, but that's okay. 28-year dividend growth streak. That's fantastic. Earnings payout ratio looks fine. Earnings per share looks like it's struggling a little bit in the last few years. Went from in 2022 it was $7.46, went down to $7.28, $7.10. Then looking next 12 months to be at $7.94. So that's good. They're moving back in the right direction. They've been buying back shares. Return on invested capital is 10%, which is it's fine. They're a highly capital intensive business as a railway. A lot of tracks, a lot of cars, unloading stations. It's just a lot of capital. And their debt structure looks reasonable. It's 50-50, 50% debt, 50% equity. I don't have any issues with that. They're a little bit light on the interest coverage ratio, but I don't find that to be too alarming. So yeah, I think Canadian National Railway looks pretty reasonable. All right, with that, guys, I think we're pretty much done. I've gotten everything I wanted to talk about tonight, and it looks like you guys might be watching the football game. So I'm going to go ahead and get off here and go check that football game out myself. So you guys have a great week. Oh, I do need to tell you something. I will be traveling starting this weekend and will not be back for a couple of weeks. So we will not have live streams on the 8th or the 15th. So the 8th or the 15th, there will be no live streams. I'll be out of town, but I hope to pick it up. And we probably won't do it on the 25th, but I'll try to find something in there somewhere. I don't want to get in the middle of your Christmas plans, but it's we'll try to do something because I don't want to go that long without doing a live stream, but we'll see. It's always fun being away, but it's always fun to be back and getting back into the swing of things. So we'll see how it goes. So with that, guys, I'm going to get off here. You guys have a great Christmas if I don't see you before then, and certainly I will not see you over the next couple of weeks. So hope everything goes well for you guys, and I will see you on the next one.